Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey everybody, welcome back to the Get Real Podcast. Ron Phillips here. And today we're going to talk about we've been getting this question a lot. Again, because there's a ton of news surrounding it, and that is what's going to happen to the housing market? What's going to happen with prices? What's going to happen? The reality of the situation is that nobody actually knows, but there's a lot of people out there who say that they know and send out information as if they know. And so I'm going to take one of those sources, and I'm just going to go through and talk about some things that are missing from the report. There's a few things that are true out there. Number one, houses are more unaffordable than they've been in a long time. That's a true statement. And house sales are down. Also a true statement. However, there are a few other things that need to be understood to know or have a decent idea about the direction of the housing market and what could happen to it. Because that's really what people are trying to figure out here, right? Trying to figure out what's actually going to happen to the sales, to the house prices. So existing home sales have dropped. Let's talk through why that's happened, right? Interest rates went way up, and they went up very quickly, okay? And because of that, it does make homes less affordable. But more importantly than that, it takes a whole section of buyers out because they have 2.5% to 3.5% loans on their properties. And they don't want to trade up in price and up in interest rate. Okay. It doesn't necessarily mean that they can't afford it. It just means that why do they want to afford it today? And it's an important distinction. All right. Because as we talk about interest rates, which we talked about, I think last week, interest rates are only one of the levers, but it's an important lever, and we're going to talk a little bit more about it in a little bit. But I want to continue talking about the challenges, right? So we have existing home sales are down, interest rates are up, affordability is a challenge. But there's another thing that's interesting, and that is that we've had a long time of interest rates being high. And so the natural progression of things should be that the supply should have gone through the roof. I mean, we should have a massive supply of properties, because everybody who prognosticates about this, they cite back to 2008 and they say, look, this is what happened in 2008. That's why this is going to happen again. Well, there's some major differences between 2008. We had an oversupply of property, a massive oversupply of property in the country. Okay. In addition to that, we didn't have the majority, like 70% or more of the loans at ridiculously low interest rates. We didn't. As a matter of fact, we had a very large majority of loans that were subprime mortgages sold to the mortgage-backed securities, bundled up together and sold as normal grade loans, and they weren't. They were crap. And banks got left holding the bag on these mortgage. Now, don't feel bad for the banks, but that's what happened. Okay, so we had all of these really bad mortgages, and we had a big oversupply of properties. And then you couple both of those things, when the market starts to correct, the banks, because they were in the problem that they were in, dumped even more properties on the market because they were forced to from the government. So we had an oversupply. We had banks oversupplying the market even more. We had horrible loan products, people losing their houses because of that, because it wasn't affordable. And as I look at the home affordability index, they're similar. However, the big difference is that there were a lot of people who had bought properties in 2005, 6, and 7 who bought them on unaffordable loans, really horrible loan products that all came calling in 2008 and they lost their properties. That's not what's going to happen here. We do not have a horde of foreclosures on the brink to dump supply onto the market. We also have a whole bunch of people who are perfectly happy with their 2.5% to 3.5% interest rate who are not putting their houses on the market. And we have builders who have slowed down because of the economic situation that we currently find ourselves in and because of interest rates. And so they're not dumping an oversupply on the market. As a matter of fact, we have less of a supply than we need right now. And that problem hasn't really gone away. Now, you can see there's a little tiny trend of it kind of going up. I think that stands to reason because the interest rates have been high. We'll see what happens as the interest rates come down. It's also pretty normal after you have a crazy high appreciation for prices to level off and even start to come down a little bit to take the top off of what was a very hot market. But we've already seen that happening and happen. But there's some things that are being left out that I think are very important when we start talking about the differences between then and now. Okay. First is the interest rates. Like I said, 65% of the country has a 4% or under loan. In addition, I'll tell you, 40% of the country doesn't have a loan at all. So they're in no danger of losing their property. So this big, massive wave of foreclosures like we had before is not impending. It's likely not going to happen. Our inventory levels are below where they need to be for normal population growth. That's not counting any of the illegal, undocumented, call them whatever you want, folks who are here, which is another, depending on who you believe, 10 to 20 million people, all who need housing. You know, right? So one other thing that I think is not really taken into consideration, if you take 7% interest mortgage rate and you say that is stasis, right? That now there's all these people who can't buy in the market and they've checked out because they can't afford it. That means that every half a point that you lower the mortgage rate, there are other people who can buy. Stands to reason that if you lower the interest rates, it makes things more affordable. So if we're not affordable now and we're coming down from 7%, let's say we go down to 6.5%, there's another 2.5 million people. We already don't have enough properties, but there's another 2.5-ish million people that can now afford to get into the market that we weren't counting before. If we get down to 6, which I think, just really quickly while I'm talking, I'm gonna look up mortgage rates and see where we're at, because like I said last time, I think in terms of investor rates. And so investor rates, they're just different, right? So if we get down, so it looks like we're around 6.5% right now. So if we get down to 6, which is what they're saying we're going to do by the end of the year, that's another 5.5 million people who can afford. So one of the things that we're not taking into consideration is that as the interest rates lower, which the Fed says they're going to continue to do into next year, there are going to be millions upon millions more people who can afford then to buy a house. And we don't have enough supply for them. And the supply is leveling off or maybe slightly growing. But it's not because of new construction, right? So where are all these people going to get their houses? Because we don't have enough houses listed on the market for them. They're not churning enough houses for them. So where are they going to come from? And if we actually drop a full point from where we are now, which is what is supposed to happen next year, there's another 7.5 million people who can afford. So when you don't have enough supply for the demand that is being created, what happens to prices? They don't go down. That's for certain. And I would also say that inflation has something to do with house pricing as well, because the builders have to pay what they have to pay for the materials to build the homes. Inflation, if you believe the government, has come down to a far lower level than it was. But I am of the opinion, no, it's not an opinion. I do not believe the government. I don't believe the statistics that they say because they're constantly going back and revising the statistics that they say. They're never right. I don't know how you get that job where you can be wrong all the time and keep your job, but they do it, right? The costs are not going down. The government is still spending a record amount of money every single year. They are not. Neither candidate has suggested that they are going to lower what the government is spending. And the government is spending too much, which means they're going to have to continue to print money, which means that the dollar is going to be inflated. It's going to be worth less money. With inflation, everything is more expensive, including all of the things that it costs to build a house. So I can't see where new construction is going to drop dramatically. So let's go back to 2008 one more time, and let's just talk through this and see where we're going to end up. 2008, we had all these mortgages. They got foreclosed on because they were horrible mortgages. These people didn't have any equity in their house, largely due to the mortgages that they had. It was really bad, right? We already had an oversupply of properties. Okay, we already had it. Banks got these properties back. They dumped them onto the market. Now we have a hyper supply of properties. So what happened to the prices? Well, the prices, in some markets, they went down by 40%. Across the board, around 20%. I think it was 19 is the average. The prices dropped dramatically. Now, one other thing that's really different between then and now is that then the banks were forced to dump these properties wholesale across the country, even in marketplaces where they didn't need to lower the prices. Like, they did it anyway because the government was forcing them to liquidate these bad assets. And at the same time, the government changed the regulations on appraisers, which would not allow for the market to recover like it should have, for those properties to be absorbed off of the market, and for those properties to start to appreciate again. It exacerbated the decline of the real estate market. And there were hundreds of thousands in markets and millions in markets. Houses were just dropped on the market all across nationally, even in markets where they shouldn't have been. And it exacerbated the problem. We don't have that right now. We have an undersupply of properties. There's no glut of foreclosures looming. And so this is entirely different than it was last time. And I don't think that's being taken into consideration. And affordability, while it is not as good as it was because the prices are higher, has already gotten better, and it will continue to get better because the interest rates are coming down. Now, what does all this mean? If interest rates come down 1% next year and there's not enough supply, that means prices are going to go up, not down. And in any case, I don't see any scenario from the market levers that we currently have, short of some, World War III or some kind of crazy thing happening. I don't see a scenario where prices drop 20% nationally or 40% in some markets. We might have an oversupply where some things, house prices might drop. But wholesale prices nationally, I don't see it happening. They might level off. It might come down just a little bit before they go back up again. But if everything that they say is going to happen happens, the odds are the prices are going to go up, not down. And so again, I'll say to the people who are waiting on interest rates, probably a bad move. Not sure what interest rates are going to do next year. Nobody really does. But they're not going to lower that much more. And it's immaterial to the deal. For everybody who's waiting for this massive market crash, because you're listening to people who are comparing now to 2008. I don't think this is 2008, people. If you actually go back and look at the market cycles that these people are talking about, 2008 is an outlier market cycle because it was upended by the mortgage industry. And we don't have that problem this time. So again, if you're waiting on everything to collapse before you invest your money, I think you're going to be sad. I don't think that's actually going to happen. And I'll remind everybody, people have been saying that the market was going to crash audibly, that I have been in meetings since 2018. One of these years, they're going to be right. The market will go down. I just don't think it's going to go down like 2008. I just don't see it. So I could be wrong. They could finally be right. But these same people that have been saying that the market was going to crash just like 2008 since 2018 have been wrong. Folks, they have been wrong for 6 years, and they have cost the people who listen to them millions and millions of dollars. There was a podcast episode that I did with my friend. I'll remind you. His name is John Galane. You can go look up the episode. Just search his name, John Galane. He bought at the top of the market in 2008. He held his property for just over 10 years after that. And I believe the number was, you could go back and correct me if I'm wrong, but I believe the number was just over or just under 30% average annual return. You can invest in any market condition if you do the numbers the right way. You can invest at any point with the interest rates, whether they're 2.5 or 9, so long as the numbers work and you run your numbers right, doesn't matter. Waiting to invest to try to time the market is a fool's errand. And on that happy note, till next week, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.